Hello traders, welcome back to another episode of Destro Forex. Have you ever looked at the Forex chart and wondered why does the price suddenly move so fast? Another time, why does it feel painful slow? Who is actually behind these massive moves? The Forex market, every move you see is driven by a powerful players making decisions behind the scene, meaning that the Forex market doesn't move by accident. In today's episode, we'll break down who are the key players in the Forex market, the role of each key players in the Forex market, and what really happens to the market when these players step away, especially during major holidays. So stay tuned till the end and don't forget to like, subscribe, and comment below. See you after the intro. Before explaining who are the participants in the Forex market, it's important to understand how access to the market has changed over time. Originally, the Forex market was exclusive to large banks, multinational corporations, and other major financial institutions. However, with the technological advancement, especially the development of internet, the market has become accessible to almost anyone. Today, even retail traders like you and me can participate in the Forex trading through online brokers who act as the intermediate between investors and the large Forex market. At the very top of the Forex market are central banks. These include the USA Federal Reserve, the European Central Bank, the Bank of England, the Bank of Japan, and many others. So, what actually are the role of these central banks in the Forex market? Firstly, they control monetary policy such as interest rates and money supply. Secondly, they help to stabilize the national currency. Let's say if inflation rises in the United States, the Federal Reserve may increase interest rates. As you know, higher interest rates usually make the USD strong because global investors prefer holding the US assets that offer better returns. Secondly, we have commercial banks and financial institutions. Big commercial banks like the JP Morgan Chase, Citibanks are the backbone of the Forex market. In fact, around 50% of the Forex trading volume come from this institution. So what are the role of these commercial banks in the Forex market? First, they facilitate currency exchange for international trade and investment. They trade Forex for profits through speculative trading. They execute Forex transactions for clients, including corporations and hedge funds and governments. Thirdly, we have multinational companies. Large global companies, also called multinational corporations, are active participants in the Forex market. Example of these multinational companies, we have the Apple and the Toyota company. Why do multinational companies use Forex? They exchange currency to pay suppliers, import and export goods, and pay employees. For example, let's say Toyota earn revenue in US dollar, but pay workers in Japanese yen. This means that Toyota must regularly convert the US dollar, Japanese yen in the Forex market in order to pay the workers. Fourthly, we have hedge funds. Hedge funds are large private investment firms that manage money for wealth individuals and institutions. They trade in many markets, including the Forex, using advanced strategy. You can think of a hedge fund as a highly skilled traders managing billions of dollars. Example of the hedge fund, we have Bridgewater Associates. So what actually are the laws of these hedge funds in Forex? Firstly, they speculate on currency movement, taking large position based on economic expectations. Let's say if a hedge fund believes the Japanese yen will weaken due to low interest rates, maybe it may buy USD JPY. Secondly, they use leverage to maximize returns. Let's say a hedge fund with 50 millions may borrow $450 million, allowing it to trade with 500 million. This means even a small price movement can result in a massive profit or a massive loss. Fifthly, we have the government. Government also participate in the forex market through central banks and sovereign wealth funds. So what are the role of the government in forex? First, they manage national foreign exchange reserves. They help maintain economic stability. They may support their domestic currency during economic crisis. Lastly, we have retail traders, the smallest but fastest growing group. This include individual traders, pro-firm traders, small private investors. So, what are their influence in the forex market? Retail traders contribute less to 5-10% of the total market volume. They don't move price, but they add liquidity. So, what actually happens in the forex market when the key players close for holidays? When major banks and institutions reduce activities or close ahead of holidays, market liquidity drops significantly. As you know, liquidity is what allows price to move smoothly. When liquidity is low, even a small order can move the market aggressively. As you can see in this chart, we often see long wicks, sudden spikes, and fake breakouts. These moves are usually not driven by real market direction, but by stop hands and position clearing. Because institutions are not full active, the market becomes easier to manipulate and harder to trade. That's why professional traders either reduce position size or stay out of the market during major holidays. Now that you understand what the key players in the forex market and how they influence price movement, you'll be able to see the market in more clarity and confidence. If this episode added value to your trading, make sure to like, subscribe, and turn on the notifications so you don't miss future episodes. Drop a comment below and let know which key players you think has the biggest impact on the market. Thanks for watching Trade Smarts, and I'll see you in the next episode of Destro Forex.